Hi, David Moore here with Equity Advantage, 1031exchange.com, and I've got Robert Smith with Peregrine Private Capital, and we're talking all things DST today. So we've been talking about some of the tax proposals, and we've talked about inflationary hedges and how real estate is the perfect inflationary hedge. And now we want to talk about DSTs, Delaware Statutory Trusts, why you might be interested in them, a little bit about their history. So Bob, you want to sort of tell a story?
A Delaware Statutory Trust is simply the legal format within which fully stabilized income-producing properties are owned and operated for a group of accredited investors. An accredited investor is an individual that has a net worth of $1 million exclusive of home equity. That's in place because of the illiquid nature of Delaware Statutory Trust property programs, meaning despite the fact that they're a security and as such fall under the purview of Securities and Exchange Commission, there is not yet an organized secondary market for them. So you can't buy them today, change your mind, and sell them tomorrow. So when you invest in a Delaware Statutory Trust, you're going to be there for the duration, which means until management decides to sell the property.
What kind of time horizon is that typically?
Delaware Statutory Trust property programs come with what's called a private placement memorandum, or a PPM, which is in effect a prospectus, if you will, on that property, meaning it discloses everything good, bad, or indifferent known about that property, and stamped all over that is the warning that you have to be prepared to hold the asset for 10 years. That being said, the average hold period for DST property over the last 21 years over all different property types has been a little bit over 6 years. It can be longer than that. It can be shorter than that. It just depends on when management decides to pull the trigger and sell the property for investors. And property management is tasked with trying to achieve the highest possible total return in the property between cash flow that you've already received and any appreciation that may occur in the underlying asset during the investment interval.
So when I tell people 5 to 7 years, I'm pretty much dead on.
I think you're pretty darn accurate.
So what's funny to me, Bob, is that often, if you look at objections to going into DST, quite often that time is one of the objections, right? The 5 to 7 year. Now, what happens if you short cycle that? And what I mean by short cycling is, let's say if the management company sees that there's an opportunity to get out, or they see a reason to get out sooner rather than later, I call that a short cycle. So what happens to the investors when you short cycle it?
When you short cycle it, the investors are actually right back where they started. They're back in 1031 exchange.
Sometimes they're upset.
And sometimes they're upset.
So when you tell them 5 to 7 years, they're upset. But then when they get into the asset and start getting that check in the mail, and now you tell them that the asset's turning.
That's a very good observation, because most people's initial concern, and it's justified when getting into a DST, is this is easy enough to get into, how the heck do I get out of it? And that's the principal rub, is it's an illiquid asset. That being said, once you get into it and people grow accustomed to that automatic deposit hitting their bank account on a monthly basis, and everything from a management standpoint being taken care of for them, when it comes time to sell the property, they can be disinclined to sell, because they've gone from a known to an unknown, and now the unknown is known, and they're very comfortable with it. So that's the ironic thing about DST sales and ownership, is that most people's primary concern is, how do I get out? But oftentimes when it does come time to get out, and management is tasked with making that decision, they are disinclined to get out, because they become very comfortable with the property and the cash flow that it generates.
So for the people out there, we talk about holding periods, and we talk about, the other sort of channel of this passive investment real estate world is still the TIC, tenancy in common. And I personally think that TICs were bloody. They got their nose bloodied during the last crash. I don't say it's a structure that was the problem, it's the sponsor that was the problem. I mean, that's my perspective. No offense to the sponsors out there, but the deal is that if you and I go buy something jointly, we've got choice, tenancy in common or as common members of an LLC typically, or some other form of partnership. Now, the LLC is a partnership. Partnerships are specifically prohibited from 1031 treatment, so that's where that TIC world grew out of. But if we look at that last crash, I mean, we had lots of problems with the TIC world. My perspective of TIC versus DST is DST is typically for a stabilized asset or a group of assets, right? I mean, you've got the financing requires that everything's there. And the TIC world, there's still institutionally provided TICs, sold TICs, but they're typically a value add play. They're going to buy an asset, and maybe they've got a carrot out there that might appear to be a nice target. Whether it gets there or not, it's something that you're going to have a cash flow and a potential pop at the end. Where the DST, you've got a stabilized asset, so you know what you're going to get, and maybe you've got a reduced pop at the end. Is there something you'd like to add to that?
Oh, yeah, it's. I mean, DST properties are like any other property. If you buy the right thing, or if you invest in the right thing at the right time at the right price, and the stars align and it goes up in value, that's a great thing. But like any other property, they can also go down. So there can be loss to principal in a DST at time of sale. There can be gain in principal in a DST at time of sale. And that is, so there is significant risk associated with it. That being said, management or the DST syndicator is tasked with trying to find you, the investor of property, that is of good enough quality that it will protect your equity against loss, and that it will provide a stable and predictable cash flow. How good management is at doing that, it depends on their longevity in the industry, their experience buying, managing, selling properties. So there's a lot of homework that any potential DST investor should do prior to pulling the trigger in terms of who the syndicator is, what their background is, what their track record's been from a management standpoint, sales standpoint, and whether they were around last time things turned down in 2008. And if they were, well, how did they make out? So you can't not do that as a potential investor in DST.
So I'm smiling because a term of today is, let's circle back to that. I'm going to have to circle back to something you just said. So what I'd like to sort of revisit is, you look at TICs, and I think the first time I met you was at the racetrack. We love cars. Anyway, fast cars. Right. But anyway, I think that was the first time I met you. But the first time I actually professionally worked with you was probably in the late 90s. And it was a presentation that you had called me up and asked me to talk on the 1031 context of the presentation. And at that point, that was that pre-DST, really? I think weren't you were. So why don't just real quickly, I made a comment a few minutes ago about, the structure wasn't the problem, as the sponsors. Now you just made a comment about management, and I just want to stress more today than ever before, the sponsor you're working with is critical, right? Now we're all living in a world with the OZ, the opportunity zone, right? And what good is a tax deferral into an investment instrument if it doesn't work, right? And you end up losing it. So DSTs are a pure development play, and it's a 10-year hold on those things to get the full pop. But if we look at and sort of talk about the beginnings of DST and sort of what happened from the TIC world into the DST and sort of how it came to be, because it's not new. I mean,
no, it's not new. DSTs actually started out as DBTs, or Delaware Business Trusts, and it morphed into the Delaware Statutory Trust. Same structure, just a name change. And DST was, the primary entity or format used in the early days of the industry, and it worked very well because with a DST, all decisions with regard to operation of the property is made by management, and that's where you want that authority vested, because most people, when they do a DST, are doing it because they want to check out emotionally, get out of the management game, and not be drawn back in. So you want management to have decision-making authority with regard to those properties. The problem with TICs is for anything substantive to happen to the property, you had to have unanimous consent on part of all the investors, and that was like herding cats, because everyone goes their own direction, is available, everyone has their own opinion. So in 2008, when some real hard and fast decisions had to be made about commercial properties as the economy tanked, it was very difficult to get that agreement with TICs, and that's why many properties suffered. But it's also, as David mentioned, management's critical. Currently, there are, I believe, 32 active property sponsors in the DST space. It's much, much better policed than it was pre-2008. And out of those 32, there are probably, I'm guessing, half a dozen that existed pre-2008, either at the institutional or retail level. So they have a track record that, that spans that period, where many other companies, and they're all, heretofore, they've been great companies, but many other companies and many brokers have just been in the DST space since 2008. And obviously, all interest rates have done since 2008 is go down, so all real estate prices in large part have done is go up. And everybody looks like a hero in a bull market, and you don't really find out who's swimming naked until the tide goes out. And, in my personal opinion, and this is just my personal opinion, it's long past time for the tide to go out. So if it was important then to do your homework with regard to who's providing this offering and who's going to be managing the offering, it's absolutely critical to the integrity of your equity going forward, because when things get tough, not all managers are created equally.
So if you look at, Tennessee in common, typically we're looking at a single asset versus, a DST could be a single asset, but most of the time it's multiple assets.
Anymore, when the product started out 21 years ago, I believe in 1999, it was usually a single property, single program, and DSTs have matured nicely in that period of time. Increasingly, we have many DSTs with multiple properties in them, albeit of a type. You'll have you'll have a multifamily DST, and in that single DST program, there will be 3, 4, 5 different multifamily properties, usually in different geographic locations around the United States for geographic diversification. We recently finished up a self-storage portfolio that had, and it was one program, and it had 15 self-storage properties diversified over 9 different Midwestern and Southeastern states. So increasingly, you can achieve diversification inside of the DST geographically. It's going to be asset type specific, and also achieve diversification functionally outside of the DST by including different property types.
Now, when you make that investment, the DST or a TIC or anything, really you're buying an asset, but the management's critical, obviously. I just want to stress, TICs, if Bob and I go buy something jointly, we could buy it Tennessee in common, or we could buy it as members of an LLC. And if we do it as members of an LLC, it might be nice and easy to run, and you're worried about the operating agreement for the LLC, which dictates the operation of that asset or the LLC itself. But it does not allow us to exchange in or out if we want to go different directions. Right. So when you're into one of those assets and it's via a common LLC, you're married to that group of people that you own that asset with, where the Tennessee in common allows us to exchange in or out. The DST is allowing you to exchange in and out wherever you want to go, from whatever you're giving up into whatever you want. What I want to stress, though, is if Bob and I go buy something, even if it's a rental house, let's say at the beach, we should have a TIC agreement. Okay, and then the reason I'm bringing this up is because what happens if 5 years after we buy the property, you're using it, I've decided I want to sell it, you'd probably like to have some idea of who is going to buy it if you're not going to buy it, or if you want to keep it, who's going to pay for the loan now that's got to be replaced in something else. But you got to have a TIC agreement, even if it's just two people owning a vacation property, and it doesn't happen very often. So if you're buying a TIC, you need to understand, to your point, if it requires unanimous consent to do an action, it's critical you understand what that TIC's operating, not the operating agreement for the LC, but the TIC agreement. A TIC agreement works like an operating agreement for a limited liability company. You got to have a TIC agreement that spells out the management of that asset or a group of assets. So understand that when you're buying into whatever you're buying into. If it's a DST, you're buying into something that the sponsor is going to manage, at least in some examples. Not all, right? I mean, it's not always a sponsor that manages the asset.
No, the bigger sponsors will internalize management, and in our humble opinion, you want internalized management because that puts management, property management, on the same side of the table as you, because they are deriving, because they're managing the property, they're deriving an income stream from that property. Essentially what they're doing is they're creating a corporate annuity for themselves by creating a larger and larger pool of managed property from which they derive a predictable management income stream. That being said, at the time a DST property is sold, Section 1031 of the Internal Revenue Code is very specific that there can be no management control over investor asset disposition. So investors are free to do whatever they want at time of sale with their money. That being said, the DST provider manager is obviously self-interested. They're going to want to have done a good enough job from a management standpoint that you only make one call and that's to me, and I only make one call and that's to them, as opposed to you going someplace else. When you outsource management to a third party, conflicts can arise. In 2008, we did, when things became very, very stressful from an economic standpoint, we did see management sometimes putting their capitalism in front of investor capitalism. So in our humble opinion, internalized management by the property provider is a good thing, not a bad thing, and not all DST property providers are big enough to do that. So that is an important consideration as well.
So if we just want to circle back to the differences between TIC and DST. TIC's a single asset, DST could be a single asset, but more often than not, it's multiple assets. Mm-hmm. You've got really no cap in number of investors to go into a DST, where you are capped on a TIC. TICs are typically going to be used on maybe a value add situation where the DST stabilized assets. So the management in the management component in a TIC is they're trying to build value in that thing over time. The management, the DST, is critical because you're really maintaining those assets, making sure they're going through what they're supposed to do during that investment life. They're not trying to create value, they're keeping that value and keeping it in line with what their expectations are to make the investors whole.
That is very well put. And I think, an important point to leave people with is because TICs were generally one property, they tended to concentrate investor assets. And we feel very, very strongly that the principal strength of DST at this point in a very late investment cycle, meaning 10 years ago, everything was cheap. Stocks, bonds, real estate. After actually 12 years of money creation and unlimited debt assumption, nothing's cheap. Everything is fully priced, if not overpriced. Stocks, bonds, commercial real estate. And so if you're selling now, congratulations, you're probably getting out of the top of the market. The problem is, unless you want to pay a buttload of taxes, you got to get back in that market. And we think the principal defense against overpaying for a single asset on the way back in is to diversify over as many different asset types as possible. And DST, as distinct from TIC, it certainly makes it much easier to diversify over different asset types, over different asset geography than you may otherwise be able to do yourself. And we think diversification going forward is going to be key in terms of maintaining the integrity of invested equity.
So I'm going to throw just one other curve in, since what we're talking about, DSTs in a lot of ways maybe sound like REITs, and some of the sponsors do sell REITs also, and other things called UPREITs too. But if we look at just to really differentiate between a REIT and a DST, I mean, a REIT's a stock, right? So you're just betting it's going up, where the DST is actually going to give you all the benefits and burdens of owning real property.
Correct. And the question's always been, can I 1031 exchange into a REIT? And the answer has almost always been, no, you can't, because it has to be direct ownership of dirt for direct ownership of dirt. And when you are investing in a REIT, as David just said, you are buying shares of a company that owns the dirt. And it's that intermediation historically that has disqualified REITs from 1031 exchange.
So I do a presentation, 1031 endgames, and one of the endgames we talk about, so I just want to clarify, it is possible to ultimately exchange your way into a REIT, but it's called an UPREIT. You're basically exchanging into an asset the REIT absorbs, and there's a process, there's a pathway to make that happen. I look at that, it's a dead end. It's a dead end. So DST you can exchange in, you can exchange out. Right? So you've got the ability, if you just want to go in for a period of time, you've got that ability. The UPREIT/REIT solution, I look at it, it's a dead end, but I look at it and I really sort of feel like it's the ultimate installment sale. Mm-hmm. So if you're looking to sell something and you don't want to take the tax hit up front, somebody might say, gee, you do an installment sale. And I think one of the biggest issues there is people don't understand they're going to pay tax on debt relief and depreciation recapture in the year of disposition, even if they didn't receive a single principal payment. And that's an eye-opener for people. Just be aware of that. But I look at the UPREIT process and it works great. If you're just done with real estate, you're done with everything. You don't want to worry about a buyer defaulting on the asset. You don't want to pay the tax up front. I think that's a good end game for people, because you literally are going to pay tax as you sell the shares of that REIT at the end of the day. So UPREITs, I think they're a wonderful tool. That's an option. It's an end game for people. But what we're talking about today is DSTs. It's a place you can go, and you can go in, you can go out via 1031, keeping your equity intact, and that's what it's all about today. So with that said, I hope you come back and listen to the next segment. David Moore, Equity Advantage, 1031exchange.com, here with Robert Smith of Peregrine Private Capital, and we're talking all things DST today. Thank you.
Thank you.
You didn't even read my story. Good girl, with these scars, I can see straight right through you. Took out my phone and I felt nervous and confused about